Hello traders, welcome back to another episode of Trader DNA. Are you seeking a reliable method to navigate the forex, stocks, and crypto markets? Well, you're in for a treat. Today, we'll explore a powerful MACD strategy that not only ensures safer entries with maximum returns, but also enhances your trading confidence. We'll delve into the specifics of this MACD strategy, illuminating why it can revolutionize the game for traders, aiming for safer entries and consistent results. Furthermore, we'll delve into candlestick patterns, chart patterns, and the underlying psychology of these trading strategies, covering everything from fundamental to advanced concepts. But hold on, there's more. We'll outline the essential criteria and rules necessary to execute successful trades using this entry method. So, if this piques your interest, please show your support by giving this video a thumbs up and subscribing to our channel if you're new. So, without further ado, let's get started. The MACD indicator serves as a valuable tool for understanding trends and momentum. To gain deeper insights, one can explore how to utilize MACD through the foundational methods outlined by its creator, Gerald Apple. Gerald Apple's Moving Average Convergence Divergence, or MACD, stands as a staple indicator found in nearly all technical analysis platforms. While there exist numerous advanced MACD trading strategies, it's advisable to commence with a basic approach. The 6 fundamental approaches I'll elucidate in this video will pave the way for a deeper understanding of handling the MACD indicator, both independently and in conjunction with other indicators. Therefore, in this tutorial, you'll thoroughly grasp the workings of MACD by studying the basic MACD trading strategy as delineated by Gerald Apple in his book, Technical Analysis. Power Tools for Active Investors. But before delving into that, let's provide a brief overview of the MACD indicator. What is the MACD indicator? Understanding the MACD indicator begins with grasping the functionality of moving averages. A significant challenge with moving averages is their tendency to trail behind price movements. This lag becomes more pronounced with longer look-back periods. For instance, the 200-period exponential moving average, or EMA, lags more compared to the 50-period EMA. The brilliance of the MACD lies in its ability to transform this drawback of moving averages into a viable trading strategy. As a trend gains momentum, a more responsive moving average with a shorter look-back period closely follows the price action. Conversely, a moving average with a longer look-back period lags behind the evolving price trend. The outcome is the divergence between these two moving averages. Conversely, in a weakening trend, the two moving averages converge. If you want to know how fast a trend is moving, what do you check? That's right, you look at the difference between two moving averages. That's exactly what the MACD indicator helps you with. First, the MACD line shows this difference. Then, it adds a signal line, which is an average of the MACD line. By paying attention to how far apart these two moving averages are, you can spot signs of a trend reversal earlier than when just looking at moving average crossovers. Here's how you can calculate the MACD line and the signal line using the MACD's default settings. First, MACD line equals 12-period exponential moving average, EMA, minus 26-period EMA. Second, signal line equals 9-period EMA of the MACD line. Your charting platform will handle the technical calculations for you. As long as you grasp the idea behind the MACD indicator, you're all set. Trading rules. MACD. Basic setup. In Gerald Apple's book, he stated supplementary rules for more conservative setups. In this tutorial, we will include these rules. MACD settings. Use the default MACD settings. First, fast, 12. Second, slow, 26. And third, smooth, 9. Long trade setup. First, MACD crosses below the signal line. Second, MACD crosses below the zero line. Third, buy when MACD crosses above its signal line. Short trade setup. First, MACD crosses above the signal line. Second, MACD crosses above the zero line. Third, sell when MACD crosses below its signal line. MACD basic trading setup examples. Here are the 5 most important examples that all traders should understand if they want to develop a reliable MACD trading method for trading in the forex, stocks, and cryptocurrency markets. These great strategies not only offer safer entries, but also boost your confidence in each of your trades. The best way to learn how to apply a trading tool is by analyzing examples. Therefore, the examples provided in this section will not only demonstrate entry points using the MACD, but also extract broader lessons to assist you in applying the MACD indicator with deeper insights. Example number 1. Deep pullback. This is an illustration of how the MACD basic setup works, particularly in a trending market. Firstly, observe that the MACD line remained above zero for an extended period, indicating a strong bull market trend. Secondly, the MACD initially crossed below its signal line before dropping below zero. These occurrences align with the additional rules of the MACD basic trading setup, suggesting a significant pullback or a potential reversal. Thirdly, the MACD line surged above its signal line, signaling a buy opportunity. One common issue with MACD trade signals is their delay, especially during price spikes. However, in this scenario, the market traded sideways for approximately a week before continuing its trend. This sideways movement allowed the MACD indicator to catch up, resulting in minimal signal lag. While perfect examples like the one demonstrated here are valuable for learning purposes, it's important to acknowledge that not all real setups will resemble this ideal scenario. Short setup. Firstly, note that the MACD line remains below zero for an extended period, indicating a strong bearish market trend. Secondly, the MACD initially crosses above its signal line before moving upward above zero. Thirdly, the MACD line declines below its signal line, signaling a selling opportunity. Example number 2. Wedge trade. We see a sell signal or bearish trend when MACD crosses below its signal line. Then, the MACD line stays below the zero line, indicating oversold market conditions. The chart pattern observed during this bearish price action is the wedge pattern. Therefore, we initiated a buy position after the MACD crossed above its signal line, along with the price breaking out of the wedge pattern. Next, the price rises, so traders earn huge profits. This trading setup based on the wedge pattern is profitable for two main reasons. Firstly, the pre-existing bullish trend can be analyzed effectively due to the emergence of the wedge pattern. If the price breaks above the pattern, it signals the start of a sustainable bullish trend. Second, the buy signal shown by the MACD below level 0 indicates that the bullish trend will continue for a long time, promising significant profits for traders. Note: sometimes, MACD signals may precede wedge pattern breakout signals, or vice versa. Wedge pattern breakout signals may precede MACD signals. In this case, the wedge pattern breakout offers an earlier signal compared to MACD. Example number 3. MACD with gap support. Like many trading indicators, it's not advisable to rely solely on the MACD. It's a good practice to combine MACD signals with price action strategies. In this instance, let's examine how a MACD trading signal was supported by a previous price gap. First, the additional criteria were met here. The drop below the zero line confirmed that the market was in a technically oversold state. Second, markets tend to fill gaps before continuing a trend. Therefore, gaps can act as potential support areas. Just before the MACD signaled a buy, we observed clear support from the filled gap. This confirmation of gap support also formed an anti-climax pattern. Third, the MACD line's bullish crossover generated a long signal, confirming the earlier bounce from the gap support zone. There are two important lessons from this example. Firstly, you can utilize the MACD trade signal to confirm a price action formation, such as the bounce from gap support, and vice versa. Secondly, you can seek earlier entries through price action analysis once the MACD crosses the zero line. While the MACD helps identify oversold markets, it's not the exact trade trigger. A nimble approach like this can lead to better entry points, especially for price action traders. Example number 4. Conservative and aggressive trades. What's the difference with the supplementary rules? This example provides an answer to that question. But in essence, if you disregard the supplementary rules, you're opting for more aggressive trading setups. First, 6 signals on this chart consist of 4 valid and 3 invalid ones if you overlook the supplementary trading rules. These are entry signals following shallow retracements in a strong trend. Second, However, if you adhere to the supplementary trading rules, such as following the 200-period EMA trend, then only these 3 MACD buy signals are valid, but all your trades are profitable. So, the supplementary trading rules help you identify less frequent, more conservative entry points. Now, when should you seek aggressive entries? And when should you look for conservative setups? Or is it always better to remain conservative? Apply this practical rule. First, if you have high confidence in the market bias, look for aggressive entries. Second, if you're unsure about the market bias, opt for conservative entries. Example number 5. MACD plus CCI. This is one of the best MACD indicator combinations. As you can see on this chart, all price movements can be perfectly interpreted by the indicator. By using the right combination, as shown in this video, our MACD trading accuracy increases significantly, while also helping beginner traders avoid the complexity often faced in market analysis. Let's dive into this strategy right away. Long setup. First, price closes above the moving average line. Second, CCI line moves upward, crossing the zero level from below. Third, MACD line is above the signal line. Fourth, initiate a buy position with a stop loss below the nearest swing low. Short setup. First, price closes below the moving average line. Second, CCI line moves downward, crossing the zero level from above. Third, MACD line is below the signal line. Fourth, initiate a sell position with a stop loss above the nearest swing high. You can adjust these settings on your trading platform, since this indicator is available on all trading platforms. Alternatively, if you want the exact settings demonstrated in this video, you can download them from the description. I've also provided a template in the video with the system that you can easily upload to your chart. It will automatically plot all these indicators accurately on your charts, so you don't have to worry about anything. Get the download link in the description. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or X to show your support. See you next time.